Okay, we'll get the party started. Welcome back from a 4-day weekend. Hopefully you all had a little bit of rest. As some of you are probably aware, I extended a few of the due dates and deadlines. Some folks got a little messed up with Friday being off and stuff being due. So I extended a couple of them into today. So in the event you want to retake a quiz from last week, it's still open, I think. But I wanted to, before I kind of dive into a few other things and dive into cost of capital, which is really from a thematic perspective, probably the last major critical concept we're going to discuss for the semester. We'll put some of those things together as we look at kind of how the firm manages cost of capital. But at the end of the day, it's kind of amazing, but we're coming down the home stretch where we've only got, less than a dozen classes left to pull everything together. So before I do that, what questions do you all have on material from prior to the Easter break or anything else? None. Okay. So I want to cover, before we dive into this, I want to cover the final a little bit. The final is going to be Tuesday of finals week. It's a 2-hour block of final. It's going to consist of two. Listen.
Sorry. How long did it take, like on average, your other class to take the final?
Fortunately for you, I'm changing the final.
Yes.
So yes, my other class, because it was a 3-hour block of instruction, I gave them 3 hours plus an hour afterwards. So it was a 4-hour long final.
They go longer than 3 hours?
Oh yes. Some folks got it done in an hour and a half because they knew the material cold. Other folks who didn't know the material cold couldn't get it done in 4 hours. However, you're fortunate in that since they've only given us a 2-hour block, you're only going to get a 2-hour final. It'll be a solid 2-hour final. So it's not going to be one where you're going to be able to get it done in half an hour unless you really don't care. So a few key things for you to know before we go into the final. Not that I want you kind of shutting the brains off between now and May 7th or May 8th when the final is that Tuesday. But I want to give you a heads up because there's some key components that you're going to need to understand going into it, and we're working on those things, and I want you to be able to focus on what's critically important. So those couple of things are, the final is going to consist of 2 parts. There's going to be a portion of the final that's going to be multiple choice questions, similar to what you've had right through the semester. But folks, those of you who know folks who have been in my JBLM class know that there are no multiple choice questions. However, that's how I can take something that was really long and compress it. So part of the shortening of the final is going to be going to multiple choice questions. So you get multiple choice questions. The final is comprehensive. So it covers from the beginning of the semester all the way through the end of the semester, the entire set of subjects. Now, if you think about a final that might contain 40 or 50 multiple choice questions and you've got, approximately 20 chapters in the books, 15, 16, and you kind of average that out and expect that I'm going to be giving about an equal allocation to each chapter, you'll realize why I started the class by saying we're well over the hump at this point and you're on the backside of the semester because only about a quarter of the questions are going to be on material we're covering through chapters 13, 14, 15, and 16. So we're on the backside. That's the good news. The bad news is that the other piece of the final is actually doing some work. That work is going to consist of 2 parts. The first part is generally coming up with a cost of capital, which we're covering today, and we've been kind of hitting right along the entire time. And if you remember, cost of capital is a reflection of what?
A series of cash flows discounted at an opportunity cost represented by interest rate.
So what's that last part? What is that?
Risk.
Risk. So we're going to be looking at how do you calculate essentially an opportunity cost, weighted average cost of capital, and that's the risk piece. And then the other part of the definition is this discounted cash flow concept. So again, if you think about what I've been emphasizing the entire semester, finance being essentially a series of cash flows discounted at an interest rate which reflects risk, the practical piece of the final, the part that's not multiple choice, is going to concentrate on those two fundamental factors. How you calculate the risk for a specific project and or company, and then how do you then do a capital budgeting problem, which is what we covered for the last couple classes, to be able to then apply that risk to a real world problem, which will likely have all sorts of things like it's more likely than not to not just be a simple do or don't do. It's more likely to be a substitute or don't substitute or replace or don't replace with things like depreciation, tax rates, multiple potential courses of action, and whether it's going to be mutually exclusive or not. Those are all things that are likely to be in that problem. Now, I haven't put the problem together yet, but I have a pretty good idea based upon the problem that I've used in the past, what it's going to look like. So if I were sitting in this class and I were going, okay, I want to try and focus my energy on what's going to be absolutely critical between now and the end of the semester and what's going to help me be successful on a relatively healthy chunk of my grade, I would focus on capital budgeting and the elements of capital budgeting that go into project finance and making those investment decisions. If you focus on those things, you're going to have covered essentially the fundamentals of finance, because you use a lot of those elements as well when you're marketing or when you're evaluating the market price or the theoretical price of a stock or a bond. And you might get some stock or bond questions as you try and figure out what the cost of capital is associated with the firm and with the project. But those would be the areas of focus. So you've got kind of a warning a month out of what is likely to be, what the final is likely to look like, where the emphasis is likely to be, and if I were you guys, where I'd be focused. I say that because it's only a month out. And so I'm going to work with the registrar's office to try and get this room at some point close to the end of the semester to walk through a few example problems for everybody. And that's likely to be scheduled as 7 o'clock or so in the evening so that folks can attend if you're working or if you've got other classes. Just because I know that that's, as we walk through some of those problems, that becomes one of those, oh my God, I've got how many steps in this problem, and I've got to kind of chunk the thing out. And so it just takes a little bit of time. The other thing is you have a month to work through a couple of these problems on your own, rework a couple of the problems that you saw in class, and build your Excel spreadsheets. And I can't say enough that those folks who did manage to complete the final up at JBLM in like an hour and a half on a 4-hour final did it because they walked in with the Excel spreadsheets ready to go. So they essentially were able to plug and chug numbers and just go, okay, this is a theoretical stock price problem. I've got an Excel spreadsheet that does that. Bang, 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 done, spits it out, and it goes. And at the end, they email me the spreadsheet. We're going to be taking the class or taking the final in an environment where it's open notes, open book, open internet, open computer, open everything. Because it's not about memorization, it's about the ability to apply the concept. And so if you have worked through a number of these capital budgeting problems and are comfortable with it, and have built out a template to be able to process the capital budgeting problem and some of the cost of capital problems and risk analysis problems that we've had throughout the course of the semester, you will find the final will go very smoothly and very quickly for you. So you've got some time to be able to do that between now and the end of the semester. If you decide to wait until the day of the final to do that, there'll be enough time, but you're not going to have a lot of time to go back and look stuff up, and you're going to have to know stuff fairly well cold to get done, because it's going to be a pretty full final. So I want to give you that heads up now. Don't say you weren't warned. For the few folks who aren't here because they're out on the road with their teams, please pass that along. I'm going to also send out an email to that effect here in the next couple of days. But I just want to let you know what you're up against so that you can prepare. Our goal in this class is to get everybody through it. And for those folks who are really interested in the material, to be able to have a basic knowledge to be able to move forward. And for those of you that aren't, to be able to go into your management, marketing, human resources, or other areas of business and recognize how financial decisions are made and be able to apply these principles when you're working with your finance teams. So that's the goal. The goal is to make sure everybody gets through. So I want to and gets through with the right information, the ability to use the tools. So I want to give that to you now so you can be well prepared. Any questions on final stuff?
The extra credit that you listed in your syllabus.
Yep.
When do you want that due by?
The extra credit can be turned in as late as Friday of finals week. So you can take the final and not do the extra credit because it's on Tuesday. And if you walk out of that final going, that was the absolute worst experience of my life, and I'll be lucky if I passed, do the extra credit problems or do the extra credit stuff. You can turn it in after.
Did you say though that like if we're passing the class right now, like the final won't fail us?
It shouldn't.
You're right.
It shouldn't, because no one piece of the class is so overweighted that it's going to drag. If you got a 0, it would drag you to a failing grade. Having said that, that means you have to have had perfect attendance. You've had to have taken all the quizzes and gotten essentially 100 on the quizzes and gotten hundreds on the midterm. So if you did that, if you got hundreds on the midterm, 100 on the quizzes, and you've been at every class, and you don't take the final, you're going to end up with a C-. So you can. Conversely, you can go through and do C- work all semester, get an A on the final, and you'll end up with a C+ or a B- because it doesn't weight that heavily. I recognize that there's folks that don't test well, especially in that kind of environment where you're compressed and you got kind of clock ticking and you got to get finished. So I don't want to penalize those folks and I also want to make sure that people who do thrive in that environment are able to thrive. And some of us don't thrive well in the, I've got a week to do this, so I'm just going to wait until 15 or 20 minutes before it's due and then kind of crank it out. Any other questions? Okay. So forewarned is forearmed, and so you should be in fairly good shape. We're going to talk through cost of capital. We spent a significant amount of time the last couple of weeks talking about capital budgeting, which is really taking the stream of cash flows and figuring out how to make an investment decision, go, no-go decision, replace or don't replace, and invest, don't invest, trying to figure out what to do with a potential choice of moving forward or not based upon financial metrics. What we're going to do now is take a look at the other component, which is really that risk component. Diving into the risk associated with the firm, the risk associated with a project, and the cost of capital associated with both. Essentially, we've gone from looking at the stream of cash flows to looking at the discount rate or the interest rate associated with it. So the cost of capital represents the required return to cover all the obligations, not only the obligations to the shareholders, but also to the bondholders and preferred stockholders. Essentially, when you've got a company or a project, it's financed with various types of cash flow or various types of capital. Those various types of capital are stocks, bonds, preferred stocks, predominantly. And stocks, in the stocks, I include retained earnings, essentially money that is allocated to the common stockholder, but retained in the firm instead of paid out as a dividend and reinvested. Those common stockholders, if you recall, have a required rate of return. They need to get enough money on it in order to justify the risk of holding the stock. And so cost of capital, as we touched on last week, cost of capital represents the firm, the cost associated with the firm in this particular case. You'll find that cost of capital will change over time, and we talk about that a little bit too, depending on the mix of projects and how the firm's risk profile changes over time. So the cost of capital is the amount, the return that's required to attract additional funds. To let people go, okay, I'm comfortable that I'm going to get an adequate return on my equity and retained earnings. The preferred stock dividends are going to be paid, and we're going to meet all of our debt obligations. You're going to find universally, not just in the book, I've tried to give you a heads up when it's the book says, this is pretty universal. Firm's required rate of return is generally in all these finance equations noted as R, lowercase r. That's required rate of return. That's the way, and we're going to talk weighted average cost of capital. That's essentially what the firm's required rate is. We're going to see this over and over and over again, and we're going to see it modified numerous times depending on the circumstance. The market determines a firm's cost of funds. We might like to think as managers that we can set what the required rate of return is, or what our bond prices are, or what we're going to pay out as preferred stock. But as you recall, sometimes if that coupon rate on the stock or on the bond or the dividend rate on the preferred stock isn't high enough, you can see the prices below par. Essentially, if you think about a bond, and we looked at some of the bonds, sometimes they sold at, or their market rate was, or their value was less than 1,000. And we've talked about 1,000 as a typical bond price. Sometimes it's more than 1,000. That's because the market says the risk is higher or lower than the coupon rate. So the market sets the rate. Our job as managers is to understand both what the market perceives about our risk and also to manage the market's perception of the risk. And that's done through active risk management as well as public relations. Cost of funds change, or the cost of capital are going to change when three things occur. And sometimes all three of these things will occur at once. And many times you're going to see two of them changing at the same time. And we'll talk through it. First, the conditions in the financial markets change. We're going to look at CAPM again. We've talked about CAPM a little bit, which really comprises a combination of beta, which is market-specific risk, or excuse me, company-specific risk, market-specific risk, and then risk-free rate. So when you see a change in financial markets, the market required rate of return is changing. That means generally you can't diversify away from it, and everything is changing. You can see changes in both the financial market required rate of return, as well as the risk premium, the risk spread. The risk-free rate may change. Investors' general risk aversion change, which is that risk spread piece. So if investors are willing to take on more risk, the risk-free rate will be higher. The market rate will be lower, and you'll see a compression of that risk premium. If investors are willing to take on less risk, there's going to be more demand for risk-free investment opportunities. Risk-free rate falls, the market premium rises, and the market rate goes up. And so you see it's basic economics, and you see a spread in the required rate of return at the market and the required risk-free rate. So this would be both of them moving up or down. This one is a change in the spread between the risk-free rate and the market. And the last one is the firm itself has a change in its risk profile. And that changes when we look at CAPM, that changes the beta. So all of a sudden the beta starts going up and down. And when you look at each of these components, you'll find that when there's a contagion, a market contagion, an economic problem, a lot of times all of these will start changing at once. You'll see that the markets get concerned about risk. And so the financial markets begin to collapse, and interest rates begin to fall, and required rates of return begin to fall. Risk aversion changes, so you'll see a spread in the risk-free rate and market rate. And then the last piece is beta may go up or down depending on what type of business your company is in. And if the market perceives that there's a change in the risk associated with that business. So if you're in a real estate business and you're seeing a financial crisis like we saw in 2008, you're seeing financial markets change, you're seeing the risk aversion change and spread, and your firm's risk is going to be perceived as going up. So all of these can change at once, and that makes it very difficult to manage. And the only one you can manage is the last one. The other two you have to be able to react to. There's a lot of equations here. As I've mentioned before, we don't memorize equations. We need to understand the concepts that go into them. And so behind that are all these definitions. And I want to talk about each of the definitions because they all start with R. And R is return. So we can talk about each of the capital components, each of the pieces of your company's capital stack, or how your company is financed, or how your project is financed, is driven by various required rates of return. Those are the rate of return required before tax on the cost of debt. So D is debt. This is after tax, because if you recall, interest payments are tax deductible. And in finance, we're only focused about cash flows. We care about cash flows. We don't care about accounting profit, we care about economic profit. And so you have a tax shield associated with the interest payment on the debt because the interest is tax deductible. So you've got an after-tax cost of debt, you've got a before-tax cost of debt. This little T shows that it is taking into effect the taxes. Return on preferred stock is the cost of preferred stock. And again, when you think about return, it's return to the investor. When you think about the company, it's the cost of issuance. You have to pay out, if you issue preferred stock, you have to pay the dividend. For you, it's a cost. For the investor, it's the return. R sub S, cost of retained earnings, cost of stock. Cost of holding the investor's money in the company. What the investor is going to require for them to say, yeah, keep that money in the company, don't pay it out as a dividend. And then R sub E is the required rate of return, or the cost of issuing new stock. And in each one of these, although this is the one that we focus on, each one of these, if you need to get more of it, if you need to get more preferred stock, you need to issue more preferred stock. If you need to issue more common equity, if you need to issue, which would be your common stock, or if you need to issue more debt, you not only have to go out and say, okay, give me money, but there's a cost called a flotation cost. That flotation cost essentially is you hire somebody, whether it's an investment banker or you have folks in-house, and you're certainly going to have to hire some high-powered attorney. I like high-powered attorneys, who will do all the documentation for both the SEC, Securities and Exchange Commission, for you to sell that, as well as all the documentation around the bond indenture, around the preferred stock offering, or around the common stock offering, to be able to get it out there. So to go get more common stock, preferred stock, or debt is never free. It's going to cost you legal fees, it's going to cost you investment banking fees, transaction fees, which for the purposes of this class, I'll get rolled up into this term called flotation costs. And so if you've got to go get something, not only do you have to pay the return associated with what the investor is going to require, but you've got to have enough return to cover the incremental additional expense associated with going to get the money. Again, we're worried about the cash flow. So from the company's perspective, not only do you have to pay this return, you also have to pay the investment bankers, the lawyers, and other folks to go get the money for you, and the return has to cover that as well. And we're going to talk through that a little bit today, or maybe Friday. Couple basic definitions. Weighted average cost of capital. I'm going to show you a weighted average cost of capital calculation. Some folks call this WACC. I don't call it WACC. Weighted average cost of capital. If you look at the weighted average cost of capital, it is exactly the way it's defined. You've got a cost of capital, you've got a type of capital, you've got a weighting in the capital structure, and you just multiply it out and add them together. The capital structure, capital stack, is how your company or project is financed. It's a combination of debt and equity and preferred stock that is out there that's financing the operations of your firm. And when I use equity, I generally am referring to common equity, which includes common stock plus retained earnings. So there's a couple different components in equity when I use equity. So for the purposes, when I'm talking, I might not follow the book's definition. I'm going to follow my definition. So when you hear equity, think common stock plus retained earnings. When you hear preferred stock is preferred stock. When you hear debt or bonds, it's debt or bonds. This refers to equity. When this refers to equity, it includes preferred stock in the book's definition. I exclude preferred stock and treat it as a separate chunk because it has a separate calculation, separate required return, and different characteristics. Cost of debt. What's relevant for us, and where this gets a little tricky, is we're looking at how the cost of debt impacts the firm as a whole. And so when we talk about cost of debt, there's two major components that the book looks at. The first one is, what's the bondholder's required rate of return? How much do we have to pay? What's the coupon rate required to get par? What does the bondholder need to get in cash? What's the required percentage rate of return? That's R sub D. And because for us, we're worried about the cash flow, we've got an after-tax savings because we can deduct the cost of that interest from our taxes. And so the cost for us is less than the coupon rate. Essentially, if you've got a cost of debt that's 12%, and you've got a 33% tax rate, our effective cost of debt is 8%. Because you have 12%, which is what the coupon rate is, minus the tax savings. So because it's 1/3, the tax rate is 1/3 for this example. You multiply the 12% by 1/3, you get 4%. That's your tax savings. So our cost of debt isn't 12%, it isn't the coupon rate. It's actually 8% because we get a tax savings, as long as there's taxable income. And so there's an attraction to debt as a financing mechanism. Why? Yes, sir.
Because if you can make, as long as the rate is low enough, if you make the rate of return, you make money on the spread.
You make money on the spread because it tends to be cheaper, and it's even cheaper because you got this tax savings piece. Use preferred stock, and there's a required rate of return of 12%. Your cost is 12%. For debt, if there's a required rate of return of 12%, your cost is, in that example I gave, 8%. In common stock or in equity, common equity, the bondholder's required rate of return is your cost. This is the one point in the capital stack or in a capital structure where what the bondholder gets and what you pay are different, and you get a savings because of the tax effect. So don't forget the tax savings. Here's an example. A firm that currently has debt with following characteristics wants to issue new debt to raise funds to support its future growth. So we're going to talk later, Friday, I think, maybe even next week, about the impacts of issuing new debt. We're going to assume for a moment that this doesn't change the risk profile of the company. So the maturity value, the par value of the bond, is 1,000. And it normally is, right? We've kind of hashed that out a few weeks ago. The coupon rate is 9%. So how much gets paid annually?
4.5.
$90 annually. If it's paid semi-annually, it's $45. Yep, it's $45 every 6 months. Years to maturity, 12. Market price, $9.31. So just looking at this now, is the required rate of return on this bond higher or lower than 9%? Why?
Because it's, it costs you less.
Yep. The required rate of return is higher than 9% because the market price is below the maturity value, below par. And so you know right out the gate, and these are just as we go through the problem, things to kind of keep in mind, that if the market price is below the maturity value, then kind of going back to chapter 4.5, the coupon rate is going to be below the required rate of return. And the marginal tax rate for this company is 40%. So let's find the yield to maturity on the bond. Essentially, if you have a present value of 931 and you have a series of cash flows, 45, 45, 45, 45, out to the 24th period, which is 12 times 2, and you get your 1,000 plus 45 back. This is nothing more than a present value problem. And what we're solving for in this case isn't the present value or the future value or stream of cash flows. It's the discount rate or the yield to maturity. And we've done yield to maturity problems before. Just Lord. Again, I should not do stuff late at night. So the example doesn't tie to my other one, but I will walk through it. So essentially what you've got here is a stream of cash flows that's going to be 45, 45, 45, 45 out to 1,045 in period 24. The way to solve this problem is to essentially lay out the cash flows in a line. Have this as your present value. Then you're going to solve in Excel for the rate of return. You can use goal seek to solve for it, which is generally how I tend to solve for things. I'm happy to walk through it since my slide is missing. Is there anybody who'd like me to walk through it?
Yes.
Yes. Okay. So we've got a present value of 931. And we've got a series of cash flows. We've got a par 1,000. We've got a rate 9%, and it's paid semi-annual. 30, 12 years. So I generally will build a cash flow line. Equal to that divided by 2. So that's my cash flows. So now we're trying to find the rate. To be the yield to maturity. So if I want a present value calc. Yep. You just want to see the formula?
Yeah.
Okay. Let me know when you're ready. Okay. So we're going to calculate the present value based upon this rate. And we've got to take this rate. So you can see how let me push this out. So the rate here, this comes up to 1,000, which is because you've got 45, 45, 45 out to 1,000, out to maturity. It's equal to the coupon rate divided by 2. Why is it divided by 2?
Paid semi-annually.
Paid semi-annually. Beautiful. So now we're going, okay, we've got to solve for yield to maturity, and we've got a present value of 931. So we're going, okay, how do I solve for yield to maturity if the present value is equal to $931? Well, the easiest way to do that, at least to me, is to go to data, what if analysis, and goal seek. And we're going to set this present value calculation to $931 by changing this rate. Goal seek, as we talked about way early in the semester, goal seek is a pretty neat feature. It essentially runs through the formula over and over and over and over again until it forces this to equal whatever you're telling it to. So we said, look, the bond is currently selling for $931. So we know that the yield to maturity, the cost, is higher than 4.5% semi-annually or 9% annually because this price is lower than that. So what's that number going to be? So if we say I want to set the present value calculation that we just did to 931, which is what was given in the problem, by changing the rate, we use goal seek, which is under that data tab. And it says 5%. So now, popping back to my slide that's missing, the rate divided by 2 is 5%. Therefore, the annual required rate is 10%. So the firm's pre-tax cost of debt is 10%. Now we need to go, okay, how do we calculate the after-tax cost of debt? Well, it's 10% times 1 minus the tax rate, or 6%. Because 4% of that, 40% of the amount that's shielded by taxes, we get to write off. So our effective after-tax cost of debt on this particular issue is 6%. Our pre-tax cost of debt is 10%. And again, if I hadn't deleted my example, our coupon rate is 9%. So you've got 3 different rates for this one bond. The coupon rate, 9%. The pre-tax effective cost, 10%. The after-tax cost, 6%. Any questions on how we calculated those things? Okay. I'm going to cover cost of equity really quick. I'm going to start with preferred stock. Cost of equity, according to the book, includes preferred stock, retained earnings, and new equity. The cost of preferred stock is essentially a perpetuity because it represents, the dividends represent an annuity. Retained earnings are earnings that are earned by the company, and instead of being paid out as dividends, are retained by the company and reinvested in new opportunities. In order to keep that money and reinvest it in new opportunities, those opportunities need to have a high enough rate of return that they compensate the investors for not getting their money back and allowing them to reinvest it into some other opportunity. And the cost of new equity is the rate of return required by common stockholders after considering the costs associated with new stock. So the cost of new equity, and new bonds would be the same way. The cost of new equity is not only the cost of retained earnings, but you've got to also add the flotation cost. You've got to get enough from that issuance to pay the expenses plus get an adequate return to the existing equity holders. And we're going to walk through the calculation of that. It's pretty straightforward. But we're going to leave today on the cost of preferred stock because it's a relatively simple concept. We've looked at it a couple times before. The cost of preferred stock is the dividend on the preferred stock at the end of the period divided by the price. Net price. Dividend on preferred stock is equal to the price of the preferred stock minus the flotation cost. We've got to account for flotation cost. We would do the same thing on bonds, by the way, but for the purposes of this book and this course, bonds are free to issue. They're not. For preferred stock, it's dividend divided by price times 1 minus flotation cost. Flotation costs, like I said, are really the cost of the attorneys, the investment bankers, the brokers, all your sales costs associated with underwriting and selling the preferred stock. Yes, sir.
If you're a big company that's listed on an exchange, don't you already have an in-house lawyer to do all that stuff for you?
Yes, probably, but you're not going to use them.
Okay.
Unless it's a good question, but securities law, and I'll just touch on it briefly. Securities law is very specialized, changes all the time. So if you're a big company, even an IBM or a Boeing or Microsoft, you're going to have securities lawyers on staff that are designed for compliance. Their expertise is compliance with securities law to make sure you don't run afoul of SEC regulations. But because you don't issue stock every day, or you don't issue stock generally every year, it doesn't pay to have that expertise, and they're very expensive, to have that expertise on your staff permanently. And also, if something goes wrong, you want to be able to sue somebody. So you hire some outside attorney, you pay them $1,000 an hour to do the work, and then if they screw it up, you sue them. And so, no, you'll have compliance folks on staff, you won't have underwriting folks who do securities offerings on staff. So here's an example of preferred stock. You have a market price of 120. The market sets the market price. I'd like to set market prices, but I can't. The dividend, and generally when you go through this underwriting process, just like with bonds and anything else, your investment bankers are going to help you underwrite and try and figure out what this dividend needs to be. So you've got a dividend of $12.80 annually. You've got a market price of 120. However, you've got a 3% flotation cost. So what you're getting as a company isn't $120 when you sell the stock. You're only getting $116.40 because the brokers, the attorneys, and all the other expenses associated with it came to 3%. And so your cost of this is $12.80 divided by 11, or $160.40, or 11%. So while it might look like your cost is 10.2, 10.3%, because if you divided this dividend by the cost or by the market price, that's what the investor's seeing. Your cost is actually a little bit higher because you've got to cover these expenses. On preferred stock, there's no taxes or no tax benefit. And so as a result, unlike bonds, where you get to after-tax cost of that debt, for preferred stock, there is no after-tax cost. It's all pre-tax. Everything has to be paid pre-tax. The difference is if you don't pay your bonds, if you don't pay your interest on your bonds, you're in default, your company can go bankrupt. On preferred stock, if you don't pay your preferred stock dividends, they accumulate, but they don't necessarily put you into default on any of your covenants, and you continue to function. So they provide more flexibility, but less tax benefit. Any questions on cost of preferred stock? All right, Friday we're going to pick it up with cost of retained earnings. Have fun.
Where this is from.